Good day. It's Bennett Stewart here to discuss CPI, the Corporate Performance Index. The story begins with TSR, or Total Shareholder Return, which has become an incredibly important metric in recent years. And yet, it is flawed. It has blind spots and is distorted in ways that prevent it from always telling the true story of how well a company is doing. Enter CPI. It's a composite score of financial excellence that confirms TSR when it is right, challenges it when it is wrong, and explains the success factors that lie behind it in any event. We compute the scores every day for 20,000 global tickers, and they are available in a free online tool called CPI Express, which I'll get to later on. Let's begin with a discussion of TSR pitfalls. First off, it can look great for firms that have merely rebounded from depressed valuations. This is much like a critical care patient that didn't die, but is far from fit. It also can look crummy for truly excellent companies that slipped even slightly, or that failed to live up to unrealistic expectations put in place years back. These are like elite mountain climbers that ascended a tall summit and took 10 steps down. TSR says they are falling, but they still have the best view around. A third problem is that TSR is influenced by leverage. Take two companies that perform exactly the same, but one is more leveraged. That one shows a higher TSR on the upswing and a lower one on the downturn. Its TSR is riskier, less reliable, not as sustainable, and should be discounted, but rarely is. A fourth problem is more episodic than systematic. TSR measures the return for a shareholder who is assumed to hold the stock through a period, and it ignores the return on shares issued or repurchased during the period. From a governance perspective, we should care about the return of the shareholders, plural, not a shareholder, but that's not how TSR is computed. TSR is also a point-to-point measure. It's based on stock price at 2 points in time. That's like judging climate change by taking the temperature on 2 days separated by 3 years. Last point. TSR is opaque, hard to fathom, and impossible to manage because it cannot be measured for lines of business or decisions. It's not clear what's driving it or how to improve it. It may be a way to keep score, but it does not help managers to win the business game. CPI answers the challenge. It uses 4 ratio metrics to distill the totality of financial performance into a single score of financial excellence. It's about 60% correlated to TSR, in the main confirming it. For 40% of the companies, though, CPI offers a different, generally much more accurate, and certainly far more understandable verdict of how well a company is really doing. And this is possible only because CPI is based on EVA, or economic value added. I'll say a few words here about EVA. Feel free to skip over this section if you are already well versed. EVA is just a special way to measure profit that is better than all others. It's economic profits following economic principles and for the purpose of managing a business and maximizing value and not to follow accounting rules. It is a simple 3-line calculation. It is sales less operating costs, which includes the depreciation and amortization of wasting assets that must be replaced to stay in business, less one more cost, less the full weighted average cost of debt and equity capital interest charge on all the net assets employed in running the business. Unlike EBITDA or EPS, EVA sets aside a priority return for the share owners before it starts to count profits. It motivates managers to use share owner capital wisely, to turn assets faster and develop leaner business models, and to invest capital carefully and accountably because they are charged for the capital. EVA is also a cheerleader. It is pro-growth. EVA increases and value increases whenever new investments generate returns above the cost of capital, even if that means existing returns or margins come down. Amazon's a great example. Its overall ROI has come down in recent years because hosting cloud computing isn't as rewarding as its original internet fulfillment business. But it is good enough. It is generating returns above the cost of capital, and that's adding to EVA. And so, Amazon's EVA is increasing, its stock price is rising, even as its ROI is coming down. Point is, the market does not want high returns per se. The market values a greater abundance of economic profits over the cost of capital. It wants more EVA. EVA also is measured after making a series of corrective adjustments to book profits. For example, R&D is written off over time, so a company doesn't look better by cutting it back, or worse if it steps it up. Also, restructuring and impairment charges are reversed and added back to capital. An impairment is a non-event. It's just added back. There are no mulligans. Managers also are rewarded for restructuring promptly and efficiently. Any new money invested in streamlining operations and redeploying resources is subject to a capital charge too. These and other adjustments built into EVA make it an even better, purer, and more comparable measure of true economic profit, which means it is ideal for the kind of cross-company comparisons that go into CPI. For more information on the adjustments, please refer to the video in the series titled Convert Accounting to Economic Reality. The real clincher for EVA, however, is that it always measures all the ways to increase value in any business. I say this with supreme confidence because the present value of a forecast for EVA is mathematically identical to the net present value of the cash flows. EVA sets aside the profit that must be earned in each period to recover the value of the capital that has been or will be invested, and so EVA always discounts to the net present value premium over or under the capital employed in the business. To increase EVA is to increase NPV, share price, and total shareholder returns by definition. I proved this in an article entitled What Determines TSR, available at our website. You can see the EVA valuation principle in action on this chart for Honeywell. The top graph plots the firm's overall market value, net of excess cash as the gray bar, and the blue bar is the capital invested in its net business assets. It's the spread that counts. The difference between money in and value out measures the owner's wealth and the firm's franchise value. It is effectively the company's aggregate NPV. It is the net present value of the business above and beyond the capital resources put into it. We call that spread MVA for market value added, and it is plotted as the gray bar on the lower left chart. Honeywell's MVA stumbled as the dot-com bubble burst, rebounded until the 2008-9 market meltdown hit, but since then management engineered a $50 billion increase in MVA, in owner wealth, from about $5 billion to $55 billion. Quite impressive, and not surprising that Honeywell's CEO David Cote was named CEO of the Year by Chief Executive Magazine a few years back based on this outstanding track record. Here EVA is overlaid on top of MVA and plotted on the right axis. Note that the two move in tandem. MVA mirrors the movement in EVA. That's to be expected because at any point in time, MVA is the present value of the EVA profits the market forecasts the company will earn. Thus, we expect to see the change in MVA and change in EVA go hand in hand, and they do. And not just for Honeywell, but in general, an observation that once led the editors of Fortune magazine to dub EVA the real key to creating wealth. I submit this is the single most important chart in corporate governance. It answers the two prime questions any board should ask at the outset. How much wealth are we creating, and how much economic profit are we generating, and what path are we on? Let's absorb two other quick examples. Look at DuPont's EVA-MVA chart at lower left. Squint your eyes, and the general impression is that EVA and MVA have gone sideways over the long haul. Yes, there have been ups and downs, but no real sustained growth in EVA, and thus there's been no real sustained growth in MVA either. No matter what other measures may say, that is a formula for a disappointed shareholder base and a door opener for the activist agenda. IBM on the right shows an impressive increase in EVA and MVA early on, But since 2013, EVA crested and has come down, and MVA tumbled too, even more so. That tells us that expectations for future growth in EVA have collapsed, and in a minute we'll put a metric on that. CPI is simply a statistical summing up of what you see on these charts. It quantifies and scores the level of EVA and MVA compared to peers, and the actual and projected growth in EVA compared to peers. And it uses a total of 4 metrics to do that. The first 2 are static snapshots, a reading of the status quo. They are the company's MVA compared to sales and EVA compared to sales. The one's an index of wealth creation and franchise value per unit of sales, and the second, a net profit margin score of business model profitability and productivity that spans operating efficiency and asset management. The EVA to sales profit margin appealingly neutralizes differences in business models. For example, Intel, the chip maker, has a massive operating margin, but it ties up so much risky capital that its net EVA margin is much lower and is much more directly comparable against even Walmart stores, which has a paper-thin operating margin, but offsets that with a wafer-thin capital. You could never compare those 2 companies on operating margins or EBITDA margins, but EVA margins, yes. It naturally makes close cousins of distant relatives. It is a sound and reliable metric to rate companies on a common scale. The other 2 metrics are dynamic and reflect change. The first of these is called trend EVA momentum. We run a regression line through the past 4 years of EVA, take the slope, and divide by the average of the sales in the first 3 periods. It's an EVA growth rate scaled to sales. And because it's based on a regression line, each EVA observation has a magnetic pull. It's a much less skittish and much more reliable measure of profit progress than any point-to-point measure of change. The last metric is the forward-looking expected growth rate in EVA. We know that the company's current MVA is the present value of the EVA the market is projecting, so we can solve for the rate of growth in EVA, again scaled to sales, that discounts to the firm's current stock price. You could think of this as the buy-side consensus for growth and economic profits. It's based on what investors are paying and not an opinion survey. So 2 of the metrics are corporate and directly under management's control, and 2 are market-based. 2 are static, status quo indicators, and 2 are dynamic, reflecting change, movement, progress, and prospects. It's a truly balanced scorecard to sum up financial performance from a shareholder point of view. Companies with high CPI scores are thus the ones that have generated the greatest growth trends in economic profits, that are presiding over the most valuable and profitable business franchises, and that are best positioned to sustain profitable growth for years to come. Companies that score high are truly excellent, no matter what their recent TSR may be. And companies that score low are really not doing well and need to be on the alert, even if TSR happens to look good. Let's use IBM as an example, with this chart reminding us of its EVA in red and MVA in blue. That sets the stage. This report displays an analysis of the 4 CPI metrics, where IBM's results are plotted in blue compared to the 25th and 75th percentile breakpoints for industry peers in red and green. The blue bars at right chart the corresponding percentile scores. As for MVA to sales, the franchise value ratio, it was clearly upper quartile above the green line in IBM's heyday, then slipped significantly in recent years, falling to the 58th percentile. In just the past 2 quarters, though, it rebounded and is once again 75th percentile. IBM's 5.9% EVA profit margin is impressive too, also upper quartile. IBM no doubt remains a profitable and valuable business. It's the dynamic metrics where it has taken it on the chin. Trend EVA momentum has turned negative in recent years as EVA headed south. Although the industry also is facing headwinds, IBM's EVA has shrunk a lot more than most. Most damning, expectations are slipping precariously. Investors are currently signaling their belief that IBM has no prospect of increasing EVA ever again, a pretty sobering statistic. By the way, the market has been very pessimistic about IBM before, but IBM reversed its fortunes. Let's hope they can do it again. This is the CPI snapshot report which brings it all together. The 10-year history of the CPI score appears upper left and shows what you'd expect from IBM's EVA-MVA record, but quantified on a percentile scale. After reaching clearly into the upper quartile, the CPI score plummeted and now trends around the 25th percentile. The current values for the 4 key rating metrics appear in the upper right blue box, and the percentile ratings for each appear in parentheses. As noted, the EVA margin stands out. It's 84th percentile. IBM's MVA margin is 105%. The stock price contains $1.05 of owner wealth and franchise value per dollar of sales, and that's also upper quartile. Trend EVA momentum, though, is minus 1.3%. Put another way, EVA has been evaporating at the rate of 1.3% of sales over the past 3 years. Only 1 of 8 companies in the industry have done worse. The real indictment, again, is that the market-implied EVA momentum, the buy-side consensus for profitable growth, is for naught. There's hardly a company in the business that is in a worse strategic predicament than IBM. Put it all together, and the composite CPI score is 26 right now, just 26 out of 100, and it would be worse if IBM was not still so profitable and so valuable. The left-hand charts plot IBM's TSR over the past 1, 3, and 5 years, which haven't been great. In fact, 3-year TSR is ranked 17th percentile against peers. That statistic is plotted left to right on the lower right chart, and IBM's CPI score of 26 is plotted north-south. The two are in close agreement. The dot connecting them falls along the lower left to upper right band, where CPI confirms and explains TSR. It's now no mystery why IBM's TSR is what it is it? That agreement is not uncommon. In fact, if you divide companies into 10 CPI bins ranked left to right and plot the median 3-year TSR percentile rank in each bin north-south, there's an obvious correlation. Simply put, the higher a company's current CPI score, the higher it tends to rank in TSR versus its competitors over the prior 1, 3, and 5 years. The conclusion seems clear. To increase TSR, one must increase CPI, and that boils down to increasing EVA. So why not pay managers for the growth trend in EVA they produce as an ideal LTIP complement to TSR? As I mentioned before, while CPI and TSR fall in line for about 60% of the companies, for about 40% of them, CPI offers a different and generally much more accurate verdict. Here's an example where TSR clearly gets it wrong. Fastenal is truly best in class in its business. It boasts a sterling set of EVA statistics. Its EVA margin is 8.6%, better than IBM and the best in its business. It generates $2.66 in wealth per dollar of sales, compared to $1.05 for IBM. Its EVA has ascended at the rate of 0.36% of sales, and investors are projecting long-run EVA growth at twice that pace. It's a very well-positioned firm. Clicking on all cylinders, its CPI sums to 100. Yet its recent TSR is nowhere near as good, just 32nd percentile. That plainly understates and misrepresents the firm's true greatness. Fastenal plots in the upper left blue zone on the CPI TSR grid where companies like it appear. Tyson Foods is at the other end of the spectrum. It's just not that impressive on the EVA scorecard. EVA margin is just 2.1%, median for its business. Owner wealth stands at 39 cents per sales dollar, thin gruel and lower quartile among food and beverage stocks. And while Tyson did manage to increase EVA along a 0.4% momentum trend line, investors don't see that as sustainable. The stock is priced for an erosion in EVA. It sums to a CPI score of 31, and yet Tyson's 3-year TSR rank is 81st percentile. Tyson plots in the lower right red zone where companies like it appear. It helps to plot CPI versus TSR across a whole industry, like this chart for IBM and its peers. The tendency for a lower left to upper right alignment is evident, and so are the outliers. Computer sciences, designated by CSC, stands in the skating on thin ice red zone. It's a Tyson Foods, maybe more so. Its CPI is the lowest in the business, but its recent TSR is not all that bad. Why the disconnect? The company's EVA-MVA chart shows why. CSC's MVA right now is 0. Its EVA profits are negative and have been falling. It's clearly not in great shape. The 3-year TSR is as high as it is only because its MVA rebounded from a very depressed valuation and because the return is measured off the depressed valuation base of 3 years ago. It's a high rate of return on very little value. It is a critical care patient that did not die, but that is far from financially fit. As I'm sure you can appreciate, CPI has many applications. Our corporate clients are using it to complement TSR and to review the success factors that lie behind it in board presentations. They are using it to challenge say-on-pay critics and activist overtures when CPI gives them a better rating, and to stay alert when CPI says their TSR rank is risky and overstates their fundamentals. They are also using it to ask, why not tie pay to 3-year trend momentum in our LTIP plans? An increasing number of governance authorities and investment firms are also using CPI to make sure they are targeting the right companies and that they can explain and support their conclusions using the 4 key EVA metrics. If you'd like to see CPI for any public company in our coverage universe of 20,000 global tickers, just link to CPI Express at http://pub.evadimensions.com/CPI Express. You can just see it here. Tap the company name or ticker you want into the upper left corner, and presto, you will be presented with a basic snapshot CPI report like the ones you've already seen, courtesy of EVA Dimensions. There's free and open access. Once you register, please give it a try. We also license access to far more capable versions that give you more detailed statistics, data tables that you can export into Excel, and the ability to automatically export a report deck into PowerPoint. You are also able to compute custom CPI scores. Here is an example where I set up a group of sporting, apparel, and lifestyle firms that could be viewed as peers of Under Armour. The CPI TSR grid shows an even stronger alignment. Almost none are much off the line. Alignment tends to be stronger when comparisons are narrowed to a more relevant list of peers, and that is a capability our Premier package provides. Please contact us at info@evadimensions.com to arrange a demo, a free trial, and a discussion of licensing options for CPI, the Corporate Performance Index of Financial Excellence. Thank you for listening.